Gold prices are at an all-time high. This is not a subjective impression, but a fact confirmed by data. What is notable is not that gold is rising, but how it is rising. While global inflation is no longer accelerating the way it did in the previous phase, gold prices continue to climb at a pace that far exceeds the general erosion of currency purchasing power. This divergence is not accidental, and it certainly cannot be explained by a familiar concept such as inflation hedge alone. For decades, gold has been viewed as a defensive asset when prices rise. But if gold were merely a reflection of inflation, the current pace of appreciation would be difficult to explain. Inflation has not doubled. Inflation has not increased exponentially. Gold has. That reality forces us to revisit a core question. What exactly is the market pricing into gold, if not just rising consumer prices? In reality, financial markets do not react only to what is happening, but also to what they fear may happen. When confidence in the purchasing power of money weakens, when monetary policy becomes increasingly reactive rather than controlled, and when systemic risk no longer resides in a single country but spreads across the global system, gold begins to assume a different role, not as a speculative asset, but as a barometer of latent instability within the current financial structure. This analysis does not aim to answer the question, should you buy gold or not? Instead, it seeks to examine the mechanisms operating beneath the surface of the market in order to understand why gold is sending such a strong signal. If you are interested in in-depth financial analysis, subscribe to the channel so you don't miss the content that follows. Before moving into any analysis, one fundamental point must be clarified. The current rise in gold is not a subjective market perception, but a reality confirmed by data. In 2025, gold prices recorded gains of more than 60%, making gold one of the strongest performing assets globally. According to aggregated reports from Reuters and the World Gold Council, this represents gold's strongest year-over-year increase since the late 1970s, a period when the world was confronting high inflation and prolonged monetary instability. More importantly, gold is not only setting nominal highs, it is also reaching new highs when measured against multiple benchmarks, against fiat currencies, against government bonds, and even against several risk asset indices over the same period. This indicates that capital flowing into gold is not a localized phenomenon, but part of a broader, systemic trend. Historically, strong rallies in gold have tended to coincide with periods when markets lose confidence in the long-term stability of monetary policy. However, unlike many previous episodes, this rally is unfolding in an environment where inflation has already cooled meaningfully from its peak. That distinction makes the current situation more complex. Markets are no longer reacting solely to monthly CPI releases. They are pricing in a wider and more layered set of risks. One point deserves emphasis. Gold is not rising in isolation. Its advance is occurring alongside heightened volatility in bond markets, increased caution in currency markets, and strategic adjustments in the reserve portfolios of numerous countries. When gold is viewed within that broader context, its sharp price appreciation becomes less puzzling and instead emerges as a signal that warrants serious analysis. Therefore, rather than asking whether gold is overhyped, a more appropriate question is, what risks is the market expressing through the price of gold? Answering that question requires a deeper examination of the most fundamental mechanisms governing the relationship between money, interest rates, and the behavior of value preservation. To understand why gold has become increasingly attractive in the current environment, it is necessary to begin with a core concept that is often overlooked in mainstream discussions: real interest rates. Real interest rates are not the figures posted on bank notice boards. They represent the return remaining after inflation is deducted. In other words, they measure whether your money is actually gaining or losing purchasing power over time. In the present context, across many major economies, nominal interest rates on deposits or government bonds fluctuate around 3 to 4%. Meanwhile, actual inflation, although it has cooled from peak levels, still remains above those rates. When inflation exceeds nominal interest rates, real interest rates turn negative. And when negative real rates persist, holding cash or short-term debt instruments ceases to be a means of preserving value and instead becomes a way of accepting a gradual loss of purchasing power over time. The critical point is this: financial markets do not wait for damage to occur before reacting. They respond as soon as a trend becomes apparent. When investors, institutions, and even major financial entities recognize that real yields are insufficient to compensate for currency debasement risk, they begin searching for alternative stores of value. Historically, gold has always appeared on that list, not because it generates cash flow, but because it does not rely on the promise of any issuing authority. At this stage, a common misconception needs to be addressed. Gold does not hedge inflation in a mechanical sense. In the short term, gold prices can move independently of consumer price indices. There are periods when inflation rises while gold trades sideways, and periods when gold rallies despite stable inflation. However, over the medium and long term, gold reflects the degree to which confidence in the purchasing power of fiat currency is being eroded. When high inflation coincides with accommodative monetary policy, or when inflation control becomes difficult due to economic and political constraints, this role of gold is activated far more forcefully. Another factor that must be considered is the current policy structure. After many years of ultra-low interest rates and large-scale quantitative easing, the global financial system has become accustomed to cheap money. When inflation emerges, raising interest rates enough to restore positive real yields requires extremely aggressive tightening. Yet such tightening carries the risk of damaging economic growth, labor markets, and financial stability. This tension is precisely what leads markets to doubt the ability of policymakers to maintain positive real interest rates for an extended period. In that environment, gold is no longer viewed merely as a hedge against price volatility, but as a substitute for cash in a world of negative real yields. When holding cash effectively guarantees a loss of value, and holding bonds fails to offer sustainably positive real returns, gold becomes a logical option for those who prioritize preserving purchasing power over maximizing nominal returns. However, this explanation alone is still insufficient to account for the full magnitude of gold's recent surge. Negative real interest rates provide the foundation, but they do not fully explain why gold has risen so much faster than inflation over the same period. To understand that divergence, we must shift to a different perspective, one in which the buyers of gold are not individual investors, but the institutions that wield the greatest influence within the global monetary system. And it is at this point that the narrative begins to change. At this point, many may settle on a familiar conclusion. Gold is rising because of inflation and negative real interest rates. That argument is not wrong. But if we stop there, we miss the most important part of the story. Because within the same negative real rate environment, gold has not always risen at the pace we are witnessing today. And under similar inflation levels in past cycles, gold's reaction has been far from uniform. What needs to be reconsidered is the relationship between cause and intensity of response. Inflation puts pressure on currencies, but it does not automatically produce explosive price moves. History shows that in many periods of moderate inflation, gold traded within relatively narrow ranges. This indicates that another factor is amplifying the impact of inflation in the current cycle. When gold prices rise far faster than the erosion of currency purchasing power, the market is reflecting not only present conditions, but expectations. Expectations that traditional tools for controlling inflation are approaching their limits. Expectations that restoring real interest rates to sustainably positive territory would require an economic and financial cost that may be politically and structurally unacceptable, and expectations that holders of capital at scale are preparing for scenarios that lie outside conventional models. It is precisely at this point that the analytical lens must widen. Instead of focusing solely on the behavior of individual investors or investment funds, attention must shift to the largest buyers of gold within the system, not to search for speculative motives, but to understand strategy. When the identity of the buyer changes, the meaning of gold's price changes with it. And that is why the next part of this analysis will focus on a group of actors often overlooked in mainstream discussions, yet decisive in shaping the current cycle. If inflation and negative real interest rates provide the foundation for gold's rise, then central banks are the force that changes both the intensity and the meaning of this cycle. This is the point many mainstream analyses overlook, because it requires viewing the gold market not from the perspective of individual investors, but from the structural standpoint of the global monetary system. Throughout the 1990s and the early 2000s, central banks around the world were, on balance, net sellers of gold. The context at the time was relatively straightforward: low inflation, stable growth, expanding globalization, and high confidence in major fiat currencies. In such an environment, gold was seen as an inefficient asset, non-yielding and balance sheet intensive. Selling gold to shift reserves into government bonds, especially U.S. Treasuries, was widely regarded as a rational reserve management decision. The turning point came after the global financial crisis of 2008 to 2009. From that moment on, central bank behavior changed in a systematic way. Instead of selling, they began to accumulate gold year after year. According to data from the World Gold Council, the period from 2022 to 2024 recorded net central bank gold purchases exceeding 1,000 tons per year, the highest level in decades. These were not tactical or short-term transactions, but a long-term trend, carried out by many countries with different motivations, yet converging on the same strategic conclusion. What must be emphasized is this: central banks do not buy gold to seek short-term profits. They do not trade based on technical charts, nor do they react to daily news. When a central bank decides to increase the share of gold in its reserves, it is making a structural decision that reflects a long-term assessment of systemic risk. For that reason, their return to gold carries a fundamentally different meaning from speculative capital flows in the market. Why has gold become attractive again on central bank balance sheets? The answer lies in three characteristics that very few assets possess simultaneously. First, gold carries no counterparty risk. It is not a liability of any government or institution. Second, gold has global liquidity. It can be traded and valued in virtually every major financial market. Third, gold is politically neutral. It is not directly tied to the fiscal or monetary authority of any single nation. In a world where the financial system is increasingly intertwined with geopolitics, these three attributes have become especially important. When foreign exchange reserves are held primarily in the form of bonds or deposits denominated in another country's currency, political considerations are no longer an external factor. They become a direct risk. Central banks, as guardians of national monetary and financial stability, cannot ignore that reality. Another important point is that this shift is not limited to emerging economies. Even countries with large reserves and highly developed financial systems have begun to reassess the structure of their reserves. This indicates that the story is not simply about escaping a particular currency, but about adapting to a more fragile global environment, one in which shocks can spread faster and penetrate more deeply than in the past. When demand comes from central banks, the gold market enters a different phase. This source of demand is durable, far less sensitive to short-term volatility, and unlikely to reverse quickly. That helps explain why gold prices can sustain a strong upward trend even during periods when traditional indicators, such as short-term inflation data or ETF flows, do not fully support it. From this point on, the meaning of gold's price is no longer primarily about yield. It is about trust and about the structure of monetary power in the modern world. When looking more deeply into the wave of gold purchases by central banks, this phenomenon cannot be separated from the rapidly changing geopolitical landscape. For decades, foreign exchange reserves were built primarily on the assumption that the global financial system operated under relatively stable rules, and that large holdings of fiat currency assets were highly safe. That assumption has been severely tested in recent years. A major turning point occurred in 2022, when a large portion of Russia's reserve assets was frozen at Western financial centers. This event does not need to be viewed through a political lens to understand its financial impact. For monetary policymakers around the world, it served as a clear signal. Foreign exchange reserves are not only a matter of liquidity and yield, but also a matter of access. When access can be restricted by political decisions, the concept of safety in reserve assets must be reassessed. From a risk management perspective, the rational response is not to replace all reserves with gold, but to diversify in a way that reduces dependence on assets carrying high political risk. In that context, gold emerges as a balancing instrument. It is not a perfect solution, but it possesses a characteristic that few other assets can offer: the ability to exist and be recognized independently of the financial system of any single country. This becomes particularly important in a world where trade tensions, economic sanctions, and strategic competition are increasingly becoming permanent policy tools. Even countries with close economic ties to major financial centers cannot fully rule out the risk of being indirectly affected by political measures. In this environment, holding a portion of reserves in gold is not a confrontational act, but a form of systemic precaution. It is important to emphasize that this shift is not occurring abruptly or uniformly. It is taking place gradually through small but consistent adjustments in reserve allocations. It is precisely this slow and persistent nature that makes its impact on the gold market so profound. Central bank demand does not generate short-term shocks, but it alters the long-term supply-demand balance, thereby shaping a new price baseline. Another aspect that receives less attention is the element of systemic psychology. When central banks, institutions that represent stability, strengthen their gold holdings, the signal sent is not only directed at markets, but also at other countries. It indicates that, in long-term assessments, the level of uncertainty in the global environment has increased. And when uncertainty becomes a permanent condition, demand for neutral assets that are less dependent on policy commitments will continue to be sustained. It is precisely in this context that gold prices reflect not only physical supply and demand, but also a deeper adjustment in how countries perceive financial security. To fully understand the significance of this shift, it is necessary to step back and examine the comparisons that are often made in debates about gold, comparisons that are partly valid, but can also lead to exaggeration if they are not placed within the appropriate context. When gold prices rise sharply and over an extended period, historical comparisons tend to appear in abundance. Some of these are useful as reference points, but many are exaggerated and can even be misleading if they are not placed in the proper context. Correcting these arguments does not weaken the case for gold. On the contrary, it enhances the credibility and analytical discipline of the discussion. First, the view that gold always rises 7 to 8 times in every cycle is an overly simplified expression. It is true that during the 2001 to 2011 period, gold rose more than sevenfold from trough to peak. However, that outcome was the result of a specific set of conditions: prolonged negative real interest rates, the global financial crisis, and unprecedented monetary easing. Not every cycle brings together all of these factors, and history shows that gold cycles vary widely in magnitude. Assigning a fixed multiplication factor to gold is therefore inconsistent with how markets actually function. Second, direct comparisons between today's developed economies and episodes of hyperinflation such as Weimar Germany or Zimbabwe must be used with extreme caution. Those examples reflect a complete collapse of fiscal, monetary, and institutional structures. By contrast, today's major economies still possess tax collection capacity, deep capital markets, and a far higher degree of policy control. This does not mean that risks do not exist, but rather that the risks are of a different nature, slower moving, and more complex. The key point here is this: history does not repeat itself in the same form, but it often repeats in terms of mechanisms. Those mechanisms include the accumulation of debt, policy pressure as choices become increasingly constrained, and a gradual shift in how major actors preserve value. Gold benefits from these mechanisms, but it does not necessarily require an accompanying scenario of extreme collapse. By removing unnecessary exaggerations, we can view gold more soberly, not as a prophecy of catastrophe, but as an indicator of growing structural stress within the financial system. It is precisely this perspective that allows subsequent analysis to focus on the real constraints facing policymakers, rather than drifting into extreme scenarios that are difficult to verify. To understand why gold's role has become more prominent in the current cycle, it is necessary to confront an unavoidable reality. Global debt levels have entered a zone of policy constraint. Not only public debt, but also private debt has risen sharply over the past decade. When total debt grows faster than nominal growth, every monetary policy decision carries a higher cost than in the past. In this context, the traditional tool for controlling inflation, raising interest rates, is no longer a cost-free option. Each rate hike expands governments' financing costs, increases pressure on budgets, and elevates risks for the private sector. Housing markets, highly leveraged companies, and the banking system all become more sensitive to interest rate shocks. This creates a policy paradox. tightening is needed to control inflation, but excessive tightening threatens financial stability. As a result, the room for maneuver for central banks has continued to narrow. Maintaining interest rates high enough to generate sustainably positive real rates requires significant sacrifices in growth and employment. At the same time, easing too early raises concerns about a resurgence of inflation. This very tension has led markets to price in an intermediate scenario. Nominal rates may fluctuate, but real rates are unlikely to remain elevated for an extended period. From a cyclical perspective, this represents an important shift. In previous cycles, sharply raising interest rates to end a gold rally was feasible, even at the cost of a short-term recession. Today, with much higher debt levels, the ability to apply that scenario again has become limited. Markets understand this and respond even before official decisions are made. It is precisely in an environment where every policy choice involves substantial trade-offs that assets not directly dependent on interest rates or debt obligations become more attractive. Gold, as a non-yielding asset that also carries no default risk, is viewed as an anchor amid prolonged uncertainty. This does not mean that gold will rise uninterrupted under all scenarios, but it does explain why demand for gold can persist even when inflation is no longer accelerating. When gold is placed within the context of high debt and policy constraints, its upward momentum is no longer difficult to understand or purely speculative. Instead, it reflects a gradual adjustment in how markets assess macroeconomic risk. From here, the question is no longer which direction policy will take in the short term, but rather, under the most plausible scenarios ahead, will gold's role continue to be reinforced, or will it begin to change? When moving from analysis of the current state to forecasting, the most important principle is discipline, not seeking absolute certainty, but identifying reasonable scenarios based on the constraints that currently exist. In the short to medium term, there are several key variables that markets are closely monitoring, and it is these variables that will determine whether gold's role continues to be reinforced. The first scenario is one in which real interest rates remain low or fluctuate around a neutral threshold. Even if inflation continues to ease, pushing real rates into clearly positive territory and maintaining them there for an extended period will face significant obstacles from growth, public debt, and financial stability. In this scenario, gold does not require a new shock to rise sharply. Simply having the current environment persist is enough for demand aimed at preserving value to be sustained. The second scenario relates to the behavior of central banks. If the trend of net gold purchases continues, even at a slower pace, the market will interpret this as a long-term adjustment in reserve structures. This does not guarantee a continuously rising price path, but it does create a durable demand floor, making corrections shallower than in previous cycles. The third scenario involves the emergence of hard-to-predict shocks, geopolitical, financial, or policy-related, that rapidly increase uncertainty. In such moments, gold typically does not need to be promoted to attract capital. Its role is activated almost reflexively. What these scenarios share is that none of them requires an immediate collapse of the monetary system. They merely assume that the current environment of uncertainty and policy constraints continues to persist. And that assumption alone is sufficient to place gold in a position that markets cannot ignore in the process of value allocation. After reviewing the data, mechanisms, and context, a cautious conclusion can be drawn. Gold does not rise solely because of inflation, nor does it require an extreme crisis scenario to maintain its role. Gold's upward momentum reflects something deeper: the adjustment in how markets and major institutions assess risk, monetary confidence, and the limits of policy. Gold is not a promise of quick profits, nor is it a universal solution for every portfolio. It is a signal that, in an environment of prolonged uncertainty, assets that are not dependent on debt obligations or policy commitments continue to be valued. Therefore, the more important question is not whether gold will rise or fall over the next few months, but rather, what are you storing your value in, and what do you trust to preserve its purchasing power over time? If you find analyses like this useful, please subscribe to the channel to follow future content on macrofinance and market structure.